European bankers laughed. In the late 1950s, London was a washed-up empire, bombed, indebted, stripped of colonies. New York and Washington ran the dollar and the world. So when a handful of desperate London bankers started dealing in a strange offshore version of the US dollar, their rivals on the continent smirked. Who, they asked, would trust a market built on loopholes, Soviet deposits, and a declining empire? But that joke didn't age well, because those offshore dollars, the Eurodollars, didn't stay small. They multiplied. They spread into every corner of global finance. And before long, even central banks lost track of where the dollar stopped and this offshore shadow system began. This is the story of how a bankrupt former empire reinvented itself as a shadow financial superpower, how money slipped the leash of governments, and why the world you live in today still runs on dollars that officially don't exist. Picture London, 1945, the city that once financed railroads across India, rubber plantations in Malaysia, and gold mines in South Africa, now rations butter. Entire neighborhoods are rubble. The docks, where ships once carried the wealth of empires, sit damaged and quiet. Britain is broke. Deeply, desperately broke. The war cost everything. The empire is dissolving. India, the jewel in the crown, is gone. Egypt, Malaysia, and dozens of other colonies are heading for the exit. And the bill? 200% of GDP in debt. Britain owes more money than its entire economy produces in a year. But here's the cruel irony. Britain doesn't just owe money. It owes dollars. American dollars. Because while Britain was fighting, America was producing. Tanks, planes, ships, food. Everything Britain needed to survive came from America. And America wanted to be paid in the world's new currency of power, the dollar. So London, the city that once was the global financial center, now had to beg Washington for dollar loans just to buy wheat. The humiliation was complete. For centuries, if you wanted to finance global trade, you came to London. You borrowed pounds sterling. You used British banks. You played by British rules. Now, London's bankers sat in their wood-paneled offices watching New York steal their clients, their relevance, their purpose. The empire of land was dead. And no one not in London, not in Washington, not anywhere imagined it would be reborn as an empire of something else entirely. While London counted its losses, the world's powers gathered in a New Hampshire resort called Bretton Woods to redesign the global financial system. The goal was simple. Never again. Never again the currency chaos of the 1930 seconds. Never again competitive devaluations. Never again the financial anarchy that helped birth fascism and the Second World War. So they built a cage. The Bretton Woods system locked currencies to the dollar, and the dollar to gold. $35 bought you 1 ounce of gold, guaranteed by 5, the U.S. Treasury. Every other currency fixed its exchange rate to the dollar. It was elegant, stable, orderly. But it came with a price. Capital controls. To make the system work, governments had to control the flow of money across borders. You couldn't just move your savings to another country on a whim. Businesses couldn't freely shift capital to chase higher returns. Banks couldn't lend across borders without permission. Money was nationalized. It belonged inside countries, subject to national laws and national politics. For ordinary people, this seemed reasonable. After the chaos of depression and war, stability felt like salvation. Your money stayed in your country's banks, earning your country's interest rates, subject to your country's rules. Safe, predictable, boring. But scratch the surface, and you could feel the tension building. Because the world economy didn't stop at national borders. Trade kept flowing. Investments needed to happen. And all of it required dollars. Europe needed to rebuild. Fast. Factories, roads, power plants, housing, everything required investment. And investment required dollars. Because if you wanted to buy American machinery or Middle Eastern oil or Brazilian coffee, you paid in dollars. The problem? There weren't enough dollars to go around. The U.S. controlled the supply. American regulators decided who could borrow dollars, at what rate, and under what conditions. The Federal Reserve set the rules. American politicians could and did limit dollar flows to serve American interests. This is what power looks like in a monetary system. Not tanks or territory, but the ability to decide who gets access to the currency everyone needs. European businesses and banks felt the squeeze. They needed dollars to grow. But Washington's rules, London's restrictions, and Bretton Woods controls all said the same thing. Not like that. Not so fast. Stay in your lane. And it wasn't just Europe. Japan needed dollars to import raw materials. Latin America needed dollars to industrialize. Even the Soviet Union, despite being locked in Cold War with America, needed dollars to participate in global trade. The entire post-war world ran on dollars. But the dollar supply was controlled by one country for one country's priorities. It was rational. It was orderly. It was the system working as designed. But whenever rules collide with profit, someone starts looking for the exit. And that exit wouldn't be found in Washington, where power was concentrated. It wouldn't be found in Frankfurt or Paris, where regulations were tight and capital controls were enforced with bureaucratic precision. It would be found in a city everyone thought was finished. London. Let me tell you about a fear that changed everything. It's 1957. The Cold War is ice cold. The Soviet Union, despite being America's mortal enemy, holds millions of dollars in American banks. Why? Because the Soviet Union sells oil, grain, and gold on global markets. And everyone pays in dollars. So Moscow accumulates dollar deposits. It's unavoidable. The dollar is the language of international commerce, even for communists. But then someone in the Kremlin asks a very reasonable question. What happens if tensions escalate? What if the Americans freeze our accounts? What if they just take our money? This wasn't paranoia. This was history. The U.S. had frozen assets before. During World War II, America seized Axis assets. During disputes with other nations, financial sanctions were a standard tool, and in the fevered atmosphere of the 1950 seconds, McCarthyism, the Red Scare, nuclear brinkmanship, anything seemed possible. So the Soviets looked for a solution. They needed to hold dollars because you can't participate in global trade without them. But they didn't want those dollars sitting in New York, subject to American law and American whims. The solution was almost too simple. Move the dollars to Europe. Not European currencies. Still dollars, but held in European banks, in European jurisdictions, technically outside American control. London became the obvious choice. Britain was neutral enough, sophisticated enough, and desperate enough to take the business. British banks had the infrastructure. British law was respected. And most importantly, British regulators were willing to look the other way. And so, quietly, Soviet dollars started flowing into London banks. These were the first Eurodollars. Dollars held outside America, stateless dollars, dollars on the run. The name itself is misleading. Eurodollar doesn't mean European currency. It means US dollars held in Europe or anywhere outside the United States. The euro prefix was just geographical shorthand. These were American dollars that had left home and weren't coming back. And they wouldn't be the last. Now, if you were a London banker in the late 1950 seconds, you were angry. Your city used to rule global finance. For 2 centuries, London was where the world's money lived. The Bank of England was the central bank of capitalism. The pound sterling was the global reserve currency. British merchant banks financed railroads in Argentina, mines in Australia, and plantations across Asia. Now you're watching New York take everything: clients, deals, prestige. Wall Street has the capital, the dollar has the power, and you're stuck in a declining economy, strangled by regulations, watching your relevance fade with every passing quarter. British regulations suffocated domestic banking. Capital controls locked down sterling. The Bank of England watched every transaction involving British currency like a hawk. If you wanted to make a pound-denominated loan, you needed permission. If you wanted to move British capital abroad, good luck with the paperwork. But then you notice something strange. British rules are suffocating when it comes to sterling and domestic business, but foreign currency transactions between non-residents, that's a gray zone. Technically, if you're dealing in dollars with foreign clients outside the normal British banking system, well, the rules get fuzzy. This is the loophole. If a London bank takes a dollar deposit from a foreign client and makes a dollar loan to another foreign client, it's not quite British banking and it's not quite American banking. It's something in between. Something offshore. The Bank of England, Britain's central bank, doesn't love this. But they also don't hate it. Because every Eurodollar deal is business for London. Jobs, fees, tax revenue, relevance. The unspoken calculation is brutally pragmatic. Britain can't compete with America's economic might. The pound is weakening. The empire is gone. But London still has something valuable: centuries of financial expertise, a sophisticated legal system, and a willingness to bend the rules to survive. So they adopt a policy that would shape the next 70 years. Light touch regulation. Don't ask too many questions. Let the market grow. Give the Americans and their strict regulations something to worry about. London bankers started pitching the concept to corporations needing dollar loans without American paperwork, to oil exporters looking for dollar deposits with better interest rates, to anyone who wanted dollars without American rules. And that's when the laughter started. Bankers in Frankfurt, Paris, and Zurich thought it was absurd. You're going to trade American dollars outside America in a bankrupt ex-empire with no gold reserves, no economic power, and no real resources? Good luck with that. The mockery was real. The skepticism was thick. At banking conferences and private clubs across Europe, London's Eurodollar experiment became a running joke. Have you heard about the British? They've lost their empire, so now they're pretending to be a bank for Soviet communists and tax dodgers. But London had one advantage no one appreciated yet. It didn't matter what the dollars were backed by. It only mattered that someone wanted them. And as it turned out, a lot of people wanted them. The first Eurodollar transactions were small, experimental, almost quaint by modern standards. A Soviet bank deposits dollars in London to avoid U.S. seizure. A European corporation takes a dollar loan from a London bank to buy American machinery, avoiding the hassle of dealing with New York regulations. An oil company parks its dollar revenues in London to earn higher interest than U.S. banks offered, thanks to lighter regulatory overhead. Each deal was a workaround. Each one bent a rule or sidestepped a regulation. But here's what made Eurodollars dangerous or brilliant, depending on your perspective. They weren't a new currency. They were just dollars, held elsewhere. Think of it this way. If I lend you 10 actual U.S. dollars, and you deposit them in a New York bank, that's normal banking. The Fed oversees it. U.S. regulators watch it. Reserve requirements apply. Deposit insurance protects it. The system is designed to prevent bank runs and maintain stability. But if you take those same $10 and deposit them in a London bank, and that London bank lends them to someone in France, who deposits them in a Paris bank, which lends them to someone in Italy. Now, the dollars are moving through a system the Fed doesn't directly control. Under rules the Fed didn't write. In jurisdictions the Fed can't fully monitor. Same dollars, different world. The beauty or the danger was in the multiplication effect. In traditional banking, regulations limit how many times a dollar can be lent out. But in the Eurodollar market, those limits were blurry at best, non-existent at worst. A single dollar deposited in London could support multiple loans, each creating a new dollar claim, each moving through the offshore system. Each theoretically redeemable for actual dollars but practically floating in a parallel financial universe. The market started small. A few million dollars here, a few million there. Transactions between insiders who understood the game. Private deals, quiet arrangements, nothing that would attract attention from regulators or politicians. But money has a way of finding opportunity. And once word spread that London offered better rates, fewer questions, and faster deals, the trickle became a stream. By the early 1960 seconds, the Eurodollar market was processing hundreds of millions of dollars. By the mid-1960 seconds, billions. What started as a workaround for nervous Soviets and desperate London bankers was about to become a parallel universe for the world's money. Because once money found this escape hatch, it didn't walk through. It ran. By the mid-1960 seconds, the laughter had stopped. Eurodollars weren't a curiosity anymore. They were a market. And that market was exploding. Corporations loved Eurodollars because London banks offered better rates than New York. Fewer regulations meant lower costs. No reserve requirements meant more. Competitive pricing, less paperwork meant faster deals. Why deal with the Federal Reserve's bureaucracy when you could get the same dollars in London with half the hassle? Oil exporters loved Eurodollars because they could park their revenues offshore, away from domestic politics and currency risk. After the Suez Crisis of 1956, Middle Eastern governments were particularly keen on keeping their dollars outside Western government control. London offered neutrality and discretion. Other banks loved Eurodollars because, and this is key, you could create dollar deposits without actually having the dollars first. Wait. Let me explain that, because it sounds impossible. In normal banking, if you want to lend someone $10, you need $10 in deposits first. The Fed and other central banks regulate this carefully. There are reserve requirements, capital rules, and oversight. The system is designed to prevent banks from creating money out of thin air and risking collapse. But in the Eurodollar market, a London bank could take a dollar deposit and lend out a multiple of that deposit to someone else, who would then redeposit those dollars in another bank, which would lend them again. The same base dollars got multiplied through the system. It's not that the banks were breaking laws. They weren't. They were operating in a space where the laws didn't clearly apply. American regulators had jurisdiction over American banks and dollars inside America. British regulators had jurisdiction over sterling and British domestic banking. But dollars held in London, between non-US parties, that was a gray zone. And because this was happening outside the US, the Fed couldn't directly control it. The Bank of England didn't want to control it. It was too valuable for London's economy, and no one else had clear jurisdiction. The result? An explosion of dollar liquidity outside America. By 1970, the Eurodollar market was worth $50 billion. By 1980, it was over $1 trillion. By the 2000s, it was measured in tens of trillions. The numbers are almost meaningless at that scale. What matters is this. A market that started as a workaround had become bigger than most national banking systems. Eurodollars weren't just financing trade anymore. They were financing everything. Corporate takeovers, government deficits, real estate booms, currency speculation, infrastructure projects, entire national budgets, and it all ran through London. Luxembourg got in on the game. Switzerland, the Bahamas, Singapore. Any jurisdiction willing to offer light regulation and banking secrecy could attract Eurodollar business. But London remained the center, the deepest market, the most sophisticated infrastructure, the most willing to look the other way. Here's the dark poetry of it. Britain lost its territorial empire. and built a financial one in its place. The old British Empire controlled land, ports, trade routes, colonies. It was visible. You could draw it on a map. You could plant a flag. You could count the territories shaded pink. The new empire controlled flows, money, liquidity, balance sheets. It was invisible. You couldn't see it on any map, but you could feel it everywhere. London became the center of offshore dollar finance. Not because Britain was strong, but because it was weak enough to tolerate regulatory arbitrage and connected enough to facilitate it. Think about the irony. The British Empire collapsed because it couldn't defend territory against nationalist movements and economic exhaustion. But the City of London, that 1 square mile of financial firms, thrived precisely because Britain was no longer a superpower with global political responsibilities. Britain didn't have to enforce monetary policy across colonies anymore. It didn't have to maintain the pound as a reserve currency. It didn't have to project power or maintain order. It just had to facilitate transactions. Be a neutral venue. Ask fewer questions than New York. Banks from Japan, France, America, and the Middle East all set up offices in London to access the Eurodollar market. They weren't coming for British capital or British power. They were coming for British permissiveness. The British government didn't complain. Every Eurodollar deal meant jobs, tax revenue, and prestige. London was relevant. Again. The city employed tens of thousands. Property values soared. Britain might be the sick man of Europe in manufacturing, but in finance, London was ascendant. But here's the unspoken bargain. Britain gave up control. In the old empire, London made the rules. British law, British governors, British troops enforced British interests. In the new one, London bent the rules to attract business. Light touch regulation became the brand. The implicit promise was, "Come here, and we won't ask too many questions." It worked spectacularly. By the 1970 seconds, London wasn't just competing with New York. In some ways, it was surpassing it. Because if you wanted to do dollar business without American oversight, London was the only game in town. Britain couldn't rule the seas anymore, so it ruled the balance sheets. The empire of territory had become an empire of ledgers. The Raj had become repo markets. The Royal Navy had become offshore banking. And no one, not in Parliament, not in Westminster, not even in the Bank of England, fully understood what they had created. Now, here's where the story gets unsettling. At some point in the late 1960 seconds and early 1970 seconds, something fundamental shifted. The Eurodollar market stopped being a market that existed outside the regulated system and became a market that was bigger than the regulated system. Let me put it this way. The dollar is an American currency, created by the Federal Reserve, backed by the U.S. government, subject to American law. That's the theory. Except, not really. Not anymore. Because by the 1970 seconds, more dollars were circulating in the Eurodollar market outside the U.S. Outside Fed control than were circulating inside the American banking system. Think about that. The world's reserve currency, the unit of account for global trade, the foundation of the Bretton Woods system, had quietly become a stateless network, operating in the shadows, subject to no single authority. The Fed could control dollar interest rates inside the U.S., but Eurodollar rates were set by supply and demand in London, influenced by thousands of banks making independent decisions. The Fed could regulate American banks, but it couldn't regulate foreign banks dealing in dollars offshore. The Fed could print dollars, but it couldn't control how many times those dollars got multiplied through the Eurodollar system. It could set reserve requirements for U.S. banks. But Eurodollar banks operated under different rules, or no rules at all. central banks around the world started realizing they were chasing shadows. They'd issue a policy directive, and the money would just move. To London, to Luxembourg, to the Cayman Islands. Want to restrict credit growth? Money borrows offshore. Want to raise interest rates? Money finds cheaper funding in Eurodollars. Want to control currency flows? Money routes through shell companies in tax havens. This wasn't a conspiracy. No one planned it. There was no secret meeting where bankers decided to subvert national sovereignty. It was an emergent system, born from thousands of individual decisions to sidestep rules, chase profits, and find the path of least resistance. But the result was the same as if someone had planned it. Money had slipped the leash. Governments thought they controlled their currencies. They could print them, regulate banks that held them, set interest rates for lending them. That's what sovereignty meant in the Bretton Woods era. They didn't. Not really. Not anymore. Because the real action was happening offshore, in markets they didn't license, under rules they didn't write, in jurisdictions they couldn't reach. And, by the time the laughter stopped, even the people who built this market couldn't fully map what they had created. The dollar had become something unprecedented in human history. A currency that belonged to one nation, but lived everywhere. Subject to no complete jurisdiction. Flowing through channels no central authority fully understood. When policymakers asked, how much dollar liquidity exists in the world? The honest answer was, we don't really know. That's when you know control has been lost. When you can't even measure the thing you're supposed to be managing. The Eurodollar market looked elegant when everything was calm, efficient, market-driven, a triumph of financial innovation over government bureaucracy. But financial systems don't stay calm. The 1,970 seconds brought chaos. The Bretton Woods system collapsed in 1971 when Nixon ended dollar-gold convertibility. The post-war order, the one built on stability, fixed exchange rates, and controlled capital, shattered. Currencies started floating. Inflation spiked. Oil prices quadrupled after the 1973 OPEC embargo. And through all of it, Eurodollars amplified every shock. When oil exporters suddenly had hundreds of billions of petrodollars. Where did that money go? Not into the regulated U.S. banking system with its rules and oversight. Into Eurodollar banks in London, which lent it aggressively to anyone who wanted it. Latin American governments borrowed billions at floating interest rates. They needed dollars to industrialize, to import machinery, to fund development. Eurodollar banks were happy to lend. No IMF conditions. No lengthy approval processes. Just money, flowing freely. It seemed like win-win. Oil exporters earned returns on their windfall. Developing countries got capital to grow. London banks collected fees. Everyone prospered. Until they didn't. When the Federal Reserve jacked up interest rates to fight inflation in the early 1980 seconds, those floating rate loans became unpayable. Mexico's debt service went from manageable to impossible, almost overnight. Brazil couldn't keep up. Argentina defaulted. The entire developing world teetered on the edge of financial collapse. And the Eurodollar market, this offshore, unregulated pool of dollars, was at the center of it. Here's the pattern that kept repeating. Boom. Leverage. Crisis. Scramble. Eurodollars made it easy to borrow. So everyone borrowed. Corporations, governments, banks, all loading up on dollar debt. Then something would go wrong, a currency shock, a policy mistake, a war, a commodity price collapse, and suddenly all that offshore debt became toxic. Central banks would scramble to contain the damage. But they were always fighting fires in a house they didn't own. The Fed didn't license Eurodollar banks. The Bank of England didn't want to strangle the city's golden goose. And no international body had the authority to regulate a market that existed everywhere and nowhere. The 1,980 seconds Latin American debt crisis. The 1,990 seconds Asian financial crisis. The Russian default in 1998. Each one had its own specific triggers, but they all shared a common structure: offshore dollar borrowing, sudden stops in funding, and contagion spreading through opaque channels that regulators couldn't see until it was too late. The system worked brilliantly in good times. It amplified growth, spread risk, and made everyone feel sophisticated. But in bad times, it became a transmission mechanism for panic. And the crises kept coming. Different countries, different triggers, same underlying structure. A massive pool of offshore dollars, outside traditional oversight, amplifying global imbalances. Now, if you want to understand the 2008 financial crisis, the one that almost broke the world, you have to understand this. Eurodollars were the prototype. The logic of Eurodollars was simple: create dollar claims outside the traditional banking system, outside the usual regulations, and outside central bank control. That logic didn't stay in London. It didn't stay in the 1,960 seconds. It metastasized. By the 1,990 seconds and 2000s, that same structure had spread everywhere, into everything. It had become the operating system of global finance. Money market funds? They're basically onshore Eurodollars. Dollar deposits that aren't quite bank deposits, outside traditional banking regulations, offering slightly higher yields because they don't have the same safety requirements. Repo markets? Short-term dollar loans secured by collateral, operating in the shadows of the regulated system. Banks and hedge funds borrowing billions overnight, rolling over the loans every day, creating a parallel funding system that looks stable until it isn't. Securitization? Taking loans, packaging them, and selling them as securities to investors worldwide, creating dollar claims that look like investments but act like money. Mortgage-backed securities, collateralized debt obligations, asset-backed commercial paper. All of it lives in the same offshore shadow zone. This is shadow banking, and it's absolutely massive. Economists estimate the shadow banking system is as large as the traditional banking system, maybe larger. Trillions and trillions of dollars. Some estimates say over $50 trillion globally, sloshing around in structures that look like banks, act like banks, create money-like claims like banks, but aren't legally banks, and therefore aren't regulated like banks. They don't have deposit insurance. They don't have the same capital requirements. They don't have access to the Fed's discount window, at least not officially. They operate in the gray zones of financial law. The Eurodollar market was the blueprint. Shadow banking is the sprawling, metastasized sequel. Same core idea: escape the rules, operate in the gray zones, create money-like claims without calling them money, offer better returns by taking on risks the regulated system isn't allowed to take. And just like Eurodollars, shadow banking looks brilliant and efficient, more flexible, more innovative, more responsive to market needs, right up until it doesn't. Right up until the moment when everyone realizes simultaneously that these supposedly safe money-like claims aren't actually money, and that no one is really backing them. September 2008. Lehman Brothers collapses. Everyone knows this part. The housing bubble. Subprime mortgages. Toxic securities. Greedy bankers. Wall Street hubris. The narrative is familiar. But here's what most people miss. The crisis wasn't just about bad American mortgages. It was about the global dollar funding system seizing up. European banks, banks in London, Paris, Frankfurt, Zurich, had loaded up on dollar assets, mortgage-backed securities, yes, but also corporate loans, structured products, derivatives, all denominated in dollars. Why? Because dollars are the global currency. If you're a major international bank, you need a dollar book. You need to serve clients who trade in dollars, borrow in dollars, invest in dollars. But European banks don't take dollar deposits from ordinary Europeans. They don't have branch networks collecting dollar savings. So where did they get their dollar funding? From shadow banking structures, money market funds, repo markets, short-term commercial paper. All the offshore Eurodollar descended mechanisms for creating dollar liquidity outside the traditional U.S. banking system. This worked brilliantly for years. European banks borrowed dollars short-term, lent them long-term, and pocketed the spread. Easy money. But their funding? That came from shadow sources that could evaporate instantly. No deposit insurance, no sticky retail customers. Just institutional investors who could pull their money at the first sign of trouble. When panic hit in September 2008, those funding sources evaporated. Money market funds stopped rolling over commercial paper. Repo counterparties demanded more collateral. The entire short-term dollar funding market froze. European banks couldn't roll over their short-term dollar debts. They were solvent on paper. Their assets still had value, but they couldn't access dollars to survive the day. They were drowning in illiquidity. This is the nightmare scenario Eurodollars created. A global economy running on dollars, with dollar funding happening outside the U.S. through structures no single authority fully controlled. And it wasn't just European banks. Asian banks, Middle Eastern banks, even major U.S. institutions that had relied on offshore funding channels. The entire shadow dollar system was seizing up. The Federal Reserve had to step in, not because it wanted to, because it had to. Because the alternative was a global financial collapse. The Fed opened emergency lending facilities with names like the Term Auction Facility and the Commercial Paper Funding Facility. It established currency swap lines with foreign central banks, the ECB, the NHSL, Bank of England, the Swiss National Bank, the Bank of Japan, letting them access dollars to lend to their own banks. Think about what that means. The Federal Reserve, the central bank of the United States, became the emergency lender of last resort not just to American banks, but to the entire offshore dollar system. To banks, it didn't regulate. In jurisdictions, it didn't control, supporting a financial structure that had grown up in the shadows. The crisis proved that the dollar system, this supposedly American currency, had quietly migrated offshore into shadows and grown so large and so essential to global finance that the Fed had no choice but to backstop it. Even if that meant expanding its mandate beyond anything the Federal Reserve Act contemplated. Even if that meant supporting institutions that had spent decades avoiding Fed oversight. Central banks saved the day. Or at least, they delayed the reckoning. They flooded the system with liquidity. They propped up insolvent institutions. They prevented a second Great Depression. But they didn't bring the system back inside the cage. They didn't re-regulate shadow banking in any meaningful way. They didn't force offshore dollars back onshore. They just patched the cracks, stabilized the system, and let the shadow markets keep growing. Because at this point, unwinding it would mean unwinding global finance itself. The offshore dollar system isn't a bug anymore. It's the operating system. And nobody, not the Fed, not the Treasury, not any collection of regulators has the power or political will to turn it off. Let's bring this back to Earth. Back to you. You live in a world where money has two speeds. If you're an ordinary person, your money is slow. It's subject to rules. You pay taxes on your income. Regulators watch your bank account. If you want to move money across borders, you fill out forms. If you try to hide income, you risk audits, fines, prison. Your financial life is visible, tracked, and controlled. But if you're wealthy, if you're a corporation, if you're connected, your money is fast. It moves through offshore accounts in jurisdictions with bank secrecy laws. It flows through Eurodollar markets, shadow banks, and special purpose vehicles in the Cayman Islands. It avoids taxes legally through transfer pricing and intellectual property arrangements. It escapes scrutiny structurally because the system is designed to let capital flow freely while keeping people trapped. This isn't a conspiracy, it's just architecture. The Eurodollar market opened the door. It proved you could build a parallel financial system outside national control. And once that door opened, it never closed. Now we have an entire offshore world. tax havens where corporations book profits without doing business, shell companies with anonymous ownership, trusts and foundations that hide wealth across generations. Structures so complex that even the people who design them sometimes lose track of where the money actually is. Wealth inequality isn't just about who earns what. It's about who gets access to which systems. The onshore system, with rules and oversight and transparency, where your wages are taxed before you even see them, where your bank reports your interest income to the government, where moving $10,000 triggers reporting requirements, or the offshore system, with flexibility and shadows and discretion, where money moves invisibly, where taxes are optional, negotiated with governments desperate for any revenue, where the same regulations that cage ordinary people don't seem to apply. And that offshore system? It was born in London in the 1950 seconds when a few desperate bankers started dealing in stateless dollars to avoid Soviet paranoia and American regulation. The rich didn't create Eurodollars, but they sure learned how to use them, and everything that came after. Here's the uncomfortable question that nobody wants to ask out loud. If money flows outside the control of any single nation, who's actually in charge? Democracies operate on a bargain. You elect leaders. They make policies. Those policies shape your economy. If you don't like the results, you vote them out and try something different. But what happens when the most important economic decisions, interest rates, credit availability, financial stability, capital allocation are determined by offshore markets that no electorate voted on? Central banks can set policy rates. But if the real action is happening in Eurodollar markets, repo markets, and shadow banks that set their own rates based on global supply and demand, how much power do central banks really have? Politicians can promise jobs, growth, stability, redistribution. But if capital can flee at the first sign of policies it doesn't like moving to London, to Luxembourg, to Singapore, who's really making the decisions? This is the world Eurodollars built. Not intentionally, but inevitably. A world where money is mobile, borderless, and slippery. Where governments are referees in a game they can't fully see, let alone control. Think about what this means for democracy. You vote for a government that promises higher taxes on the wealthy to fund public services, but the wealthy shift their assets offshore, legally, and the tax revenue never materializes. You vote for stricter financial regulation, but the financial activity migrates to jurisdictions with lighter rules, and your economy suffers capital flight. The power isn't with elected officials anymore. It's with whoever controls the offshore channels, the bankers who facilitate the flows, the lawyers who design the structures, the jurisdictions that compete to offer the most permissive environment. This is regulatory arbitrage at a civilizational scale. Nations compete to attract capital by weakening rules. The result is a race to the bottom where everyone loses except the capital. And where does the capital pool? In shadow banking systems, in offshore dollar markets, in structures that look exactly like what the Eurodollar market pioneered 70 years ago. Central banks are firefighters, rushing from blaze to blaze. They're not architects. They don't own the house. They don't set the building codes. They just try to keep it from burning down. When the next crisis comes, and it will, central banks will once again flood the system with liquidity, prop up failing institutions, and prevent catastrophe. Because that's what they do. That's all they can do. But they can't prevent the crisis in the first place. Because the structures that create instability exist outside their jurisdiction, beyond their vision, in shadows they don't illuminate. You live in a world where money has two speeds. If you're an ordinary person, your money is slow, subject to rules, taxed, monitored. If you want to move it across borders, you fill out forms. Try to hide income, you risk prison. But if you're wealthy, if you're a corporation, your money is fast. It moves through offshore accounts, Eurodollar markets, shadow banks. It avoids taxes legally. It escapes scrutiny structurally. This isn't conspiracy, it's architecture. The Eurodollar market opened the door. It proved you could build a parallel financial system outside national control. Once that door opened, it never closed. Now we have tax havens, shell companies, structures so complex even their designers lose track. Wealth inequality isn't just about who earns what. It's about who gets access to which systems. The onshore system, with rules and transparency, or the offshore system, with flexibility and shadows. That offshore system, born in London 1950 seconds when desperate bankers started dealing in stateless dollars. If money flows outside any single nation's control, who's actually in charge? Democracies operate on a bargain. You elect leaders. They make policies. Those policies shape your economy. But what happens when the most important economic decisions are determined by offshore markets no electorate voted on? Central banks can set policy rates. But if the real action happens in Eurodollar markets and shadow banks, how much power do they really have? Politicians promise jobs, growth, stability. But if capital flees at the first sign of policies it dislikes, who's really deciding? This is the world Eurodollars built. Money is mobile, borderless, slippery. Governments are referees in a game they can't fully see. Central banks are firefighters, rushing from blaze to blaze. They don't own the house. They just try to keep it from burning down. Financial regulators fear the risks they can't see. Offshore structures, shadow banking channels. Eurodollar markets evolved into something more complex and opaque. Financial crises don't start in regulated systems. They start in shadows, where leverage builds unseen, where everyone assumes someone else is watching, but nobody is. The next crisis will emerge from some corner of the offshore dollar system that seemed safe until it wasn't. The pattern: offshore dollars, multiplied through shadow structures, funding assets that look safe. Then, panic, contagion, central banks scrambling. We've seen this. 1982, 1997, 1998, 2008. Each time bigger. Each time we promise to fix it. And each time we don't. Because fixing it means unwinding the offshore dollar system. And that system isn't peripheral. It's the core. It's how global trade is financed. How international investments flow. You can't unplug it without unraveling everything. Eurodollars are a wealth machine, not for everyone, for those who know how to use them. When money lives offshore, outside tax systems and oversight, it accumulates faster, compounds without friction. If you're wealthy enough, your dollars earn higher returns, pay lower taxes, face fewer restrictions. You shift between jurisdictions, chasing the best rates. This is why wealth inequality exploded as offshore finance grew. The rich don't just earn more. Their money lives in a different system. Faster. Built on the Eurodollar logic of escaping control. Meanwhile, ordinary wage earners see income taxed at source. Economic lives lived entirely onshore, subject to every rule. The Eurodollar market didn't create inequality, but it turbocharged it. Built infrastructure that lets capital escape while labor stays trapped. Most people don't even know it exists. They just feel the results. Stagnant wages while corporate profits soar. Austerity at home while wealth pools offshore. A sense the economy is rigged. This is how. The offshore dollar system, hiding in plain sight since the 1950 seconds. European bankers laughing at London's offshore dollar market in the 1950 seconds. Who would trust a market built on loopholes, Soviet deposits, and a declining empire? They were right to be skeptical. It was absurd, desperate. But they were wrong about what it meant. That absurd market became the blueprint for shadow banking, for offshore finance, for a global system where dollars flow everywhere, subject to no one. London lost its territorial empire. but built something more powerful. A financial empire that doesn't need gunboats, just ledgers, loopholes, and light-touch regulation. Every financial crisis traces back to offshore dollars, shadow banking structures, leverage in places regulators don't look. When the next crisis hits, it won't start in a regulated bank the Fed oversees. It'll start in some offshore corner. The crisis will spread faster than regulators can respond. Central banks will step in. Again, flood the system with liquidity, prevent catastrophe. But they won't fix the underlying problem, because the problem isn't a bug, it's the system itself. Money slipped the leash in the 1,950 seconds. It never went back. Every attempt to re-regulate fails. Too much money to be made in shadows. Too many powerful interests invested in keeping the BU's offshore world alive. History isn't clean breaks. It's workarounds that become the system. Eurodollars were a workaround. Now they're the world. The bankers stopped laughing long ago. But we've never started asking the right questions. Who controls money when it slips the leash of governments? What happens when the reserve currency becomes stateless? Can a system built on escaping rules ever be stable? And the question that should haunt us? If central banks can only react to crises in a system they don't control, and that system keeps growing faster than regulation can contain it, what happens when the next crisis is too big even for central banks? I don't have all the answers. Nobody does. This system has grown so large, so opaque, that even experts can't fully map it. But if you want to understand the financial world you live in, the inequality, the crises, the sense something fundamental is broken, you have to understand this story. How offshore dollars escaped the cage and never came back. How a bankrupt empire reinvented itself, building a shadow financial system that outlasted everything. How money became stateless. How capital became more powerful than countries. European bankers laughed. Then they stopped. And now we're all living in the world that Joe created, where money moves at light speed through fiber optics connecting tax havens and shadow banks, where the real economy struggles under a financial system 10 times its size, where every crisis reveals the same truth. We built something we can't control. The scary part? We might not even want to control it. Too many people benefit from the chaos. Too much wealth in shadows. Too much power through offshore channels. So we'll keep patching, reacting, hoping each crisis isn't the last. And the offshore dollars, those stateless descendants of Soviet deposits and London loopholes, they'll keep flowing. Because that's what money does once it escapes. It finds every crack, exploits every gap, flows where rules are weakest, and returns highest. Money slipped the leash 70 years ago, and it's never going back.